Hi everyone, we are Team IMPETUS, and today our topic is Eurobonds are the answer to the Eurozone crisis. And this is our team members, I'm Mingshan, and this is Xu Song and Garaf and Mingwen. And today it is our outline. We will go introduce the Eurozone, Euro crisis, and Eurobond first, and we will talk about the advantages of the Eurobond. And we will discuss about the moral hazard problem of Eurobond, and then we will make a conclusion on it. Okay, now I'll let Graf to go first about the introduction.
Come on, man.
As we can clearly see the situation in Eurozone at the moment, they are suffering from the sovereign debt crisis. As you can see that most of the countries in the Eurozone region, they have really high debt to GDP ratio, which is always more than 60% of their GDP. And as you can also see that they are also suffering from the deficit crisis, which basically means that the deficit to GDP ratio is always less than 3% in these Eurozone countries, except for a few of them which are the strongest economies in this Eurozone. Now, what basically happens because of the high debt to GDP ratio? The implications are that these countries basically cannot raise further debt because they already are buried under the burden of the high debt to GDP ratios. Now, in case they go to the market and ask for more debt, then they have to pay a higher interest rate on these new loans. And moreover, the condition worsens because of a very low deficit in these Eurozone nations. With this low deficit, the government is earning less and spending more. So basically, they don't have enough money to actually service their debt. They cannot get rid of their debt on the basis of their deficit. So as you can also see that the GDP condition in these economies is not that good. The GDP has been decreasing, it has been reducing gradually over the years. So which basically means these countries are not that competitive in the world. And specifically if you talk about the PIGS countries, which are Portugal, Ireland, Italy, Greece and Spain, these are the main countries that basically are the weakest economies in the Eurozone region. And because they don't have any GDP growth, so their productivity is too less, that's why they cannot generate any revenues within the nations to actually fund their deficit, service their deficit, and to provide the servicing cost to the existing debts on their economy. And that's not the only scenario. That's not the only situation with them. Even their bond yields are very high, which basically means that the investors find these economies very risky. And if these economies are very risky, on the basis of bond yields, we can actually say that. And if these economies are very risky, then the investor won't be interested in investing in these economies. So no fund inflow is basically happening in these economies. So the situation of these already weak economies actually worsens because of this situation. Now, what can these economies basically do to improve their circumstances? Can they use the monetary policy? They cannot, because the monetary policy is being controlled by a centralized institution which is called European Central Bank. They cannot fiddle with their currency. They cannot depreciate the currency with the hope to actually boost their exports, because that policy is being controlled by ECB. Can they use their fiscal policy? Say, for instance, can they actually increase the tax rate so that they can generate more revenue from the public? They cannot do that basically because the unemployment is so high in this economy and the businesses are not doing good. Productivity rate is so low in these countries, so they cannot generate any income from the public to actually fund their deficit or service their debts. Austerity, as we have seen previously in the previous debates, austerity definitely is creating social upheaval and the public unrest. We cannot continue with that. And austerity basically means more reduction in the public investment, which actually should not happen with these economies. If that happens, then there is no more investment that is being made in the economy, so no boost to the economy. Can they actually do the managed defaults? They definitely cannot do that because most of the creditors for these economies are the European banks. And if these economies actually default, then they default on the loans that are being provided by these European banks. So there would emerge the banking crisis in these economies. So the situation would deteriorate way low.
On the previous slide, we can see that the situation within Eurozone is really bad. The PIG countries cannot pay their debt and the investor confidence is not that high. Since there's no investors gonna
invest in the PIGS country's bond. Then how can we achieve those two objectives? Eurobonds should be the answer. What is Eurobond? Eurobond is joint liability mechanism wherein Eurozone members combine their credibility to back Eurobonds. So Eurobonds are the answer to Eurozone crisis. Then what are the advantages of Eurobond? The most significant benefit of Eurobond is that it leads to a lower interest rate. Due to the increased depth, breadth, and liquidity of Eurobond, investors should be more than happy to hold that. By combining 17 countries, the interest rate of the whole Eurozone should be decreased. Eurobond can reduce the risk of being default. For countries like Italy, Ireland, and Greece, their debt over GDP ratio is originally high, indicating that they have a high probability of being default, and they are unable to bear more potential losses. Converting to Eurobond will benefit those countries by avoiding the potential banking crisis. Also, the debt over GDP ratio of the whole Eurozone is very low compared to the other countries. So they have the ability to issue bonds. Therefore, issuing Eurobond can benefit the whole Eurozone. Issuing Eurozone could also effectively reduce the cost of borrowing money. The payment of interest and principal would be shared by 17 members of the Eurozone. It is similar to an all-stock merger of companies involving the exchange of shares without requiring additional commitment of capital. For example, if Eurobonds were issued, Portugal would see an annual interest of 15 billion euros, approximately $18.72 million, where it accounts for 7% of its GDP.
Besides the advantages that Mingwen mentioned, there are several more advantages here of issuing Eurobonds. First of all, it will immediately resolve the current euro debt crisis in the Eurozone. Since the crisis was mainly caused by euro default that may happen among some certain member countries, a common bond backed by 17 member states, such as Eurobond, can release these fears. Anyway, the collectively backed bond is stronger than one backed by a single government. Secondly, by reducing the interest rate at which states finance their debt, Eurobonds save governments considerable amount in interest payment and reduce future budget deficit, and also improve the sustainability of the euro area debt levels. Improving the debt dynamics in the long run improves the fiscal outlook and justifies lower financing rates. Thirdly, it reduces the degrees to which that some countries need to apply short-term authority measures to rein in their budget deficit, reduces the risk of accession, and facilitates growth in GDP for the whole region in the medium and the long run. Fourth, it transforms the currently fragmented European capital market for sovereign bonds into one single and vast European government bond market that matches that of US Treasury. Since the European government bond market value is 10.3 trillion, it's comparable to the market value of US Treasury, which is 17.5 trillion. And this enables Eurobond big liquidity to trade and safety to hold. Then investors can buy and sell Eurobonds with minimum impact on price, yields, and exchange rate. Finally, by contemplating the European government bond market to the same league as America, it complements and solidifies the European role as a global reserve asset. Presently, the euro has become the second most important currency on the planet for the official store of value, but it lags severely behind the US dollars as a means of payment instrument because European debt markets are fragmented and small. By creating a single debt instrument traded in a vast market, it makes it impossible to use the Eurobond the same way as US Treasury are used today by international investors as a payment tool as well.
Now I'm going to talk about the moral hazard. How can we avoid it? I know some people might question that Eurobond would remove the disciplining effect of capital markets and the ability of members to issue more debt, and then will in turn create a moral hazard. Focus on this problem, we have two solutions. And the first solution is that instead of countries paying internally the same interest rate on their share of Eurobond, it can create a structure of escalating rates proportional to the debt to GDP ratio of each country. For example, we assume that if average weighted interest rate of the Eurobond is 4%, member countries will pay interest rate equal to 4% of their share of the total Eurobond as long as their debt to GDP ratio is below 60%. As the debt to GDP ratio rises above 60%, the interest rate will rise on the portion above 60. For example, a country with 100 debt to GDP ratio, it would pay 4% on the first 60 portion of its debt, and then pay 6.6% on the remaining 40%. This mechanism can ensure that credit-worthy members are not penalized for those members' wasteful spending, and to create the incentives for countries to maintain debt ratio at nice levels by either reducing debt or growing economies. Also, the second solution is participating governments would have limited volume of bonds they can issue. Specifically, they would be constrained from issuing bonds worth more than 60% of GDP. For those joint liability bonds issued lower than the 60% of GDP threshold are blue bond. The coupon of the blue bond is cheaper. On the other hand, for those bond issuance above the threshold are red bonds. Red bonds are not backed by Eurozone, and then they have higher coupon. The benefit of this solution is that countries that choose to participate in the common bond issuance would have to accept much closer scrutiny of their national statistics and fiscal accounts. In addition, the other benefit is heightened transparency that it would provide in terms of both financial market and the countries themselves. Market participants would know exactly not only how much excessive borrowing of a country was engaged in, but also which of a country's debt instruments are most susceptible to the risk of sovereign default. And then we go on to our conclusion. First, for Eurozone, to recover the investor trust must grow and the suffering nations must become sustainable. And second, Eurobonds would be only solve the crisis situation in Eurozone, but would make Euro the preferred store of value in comparison with dollars. Therefore, Eurobonds are the answer to the Eurozone crisis.